Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the third best-selling tracker fund on the AJ Bell Youinvest platform at the moment, namely Vanguard FTSE 250. This tracker product is an ETF, or Exchange Traded Fund. It's designed to track, or mirror, the performance of the underlying assets and deliver their performance minus any running costs. In this case, the tracker is following the UK's mid-cap index, the FTSE 250, some of those firms of whom are pushing to get into UK PLC's Premier League, the FTSE 100. Now, the smallest stock in the FTSE 250 right now has a market cap of just under 300 million quid, and the largest is valued at more than 4 billion. Vanguard FTSE 250 uses physical or direct replication to generate performance, so it owns the underlying securities. The biggest 5 holdings, according to the latest fact sheet, are engineering conglomerate Smiths, chemicals firm Croda, online real estate agent Rightmove, car dealer Auto Trader, and packaging player DS Smith. Note that the tracker does not include investment trusts in its remit, so the underlying number of holdings is actually just over 200, not the 250 that you'd expect. Launched in 2014, the tracker's got just over £150 million in assets under administration, so it's not the biggest, but it does come with an ongoing charge figure of just 0.1% a year. The yield is around 3.3% and dividends are paid quarterly. As a final point, Vanguard FTSE 250 is one of the 16 members of the top tracker list used by our investment guidance service, although it doesn't feature in any of the 3 actual model portfolios at the moment. So those are the mechanics. The question is, why should your fellow investors be thinking about buying this instrument now? And I think there are 3 possible reasons. First, the FTSE 250 has markedly underperformed the FTSE 100 since the UK's decision to leave the EU on the 23rd of June, and a lot of stocks in the mid-cap index have taken a drubbing amid fears a British recession is on the way. This chart shows the capital returns from the 2 benchmarks since the vote. It's too early to tell what's going to happen, but someone somewhere seems to think a lot of bad news is already in the price, or that fears of a downturn are simply indeed overblown. Second, and I know this sounds daft, the FTSE 250 is not the FTSE 100, and by that I mean the index is a very different shape to it. The FTSE 100 gets around 3/4 of its sales from overseas, outside the UK, and its earnings and dividend profiles are dominated by oils, miners, banks and insurers, a mix which may or may not appeal. By contrast, the FTSE 250 is a much greater domestic focused. It's more of a kind of best of British benchmark, and its biggest sector weightings are industrials, consumer cyclicals and financials, as this next chart shows. Third, the FTSE 250 may have underperformed the big boys of the 100 of late, but since 2000, the mid-caps have left the mega-caps for dead, as this chart shows. So investors seeking a combination of growth and income may therefore feel the FTSE 250 is better suited to their purposes, remembering Jim Slater's old line about elephants don't gallop when it comes to the FTSE 100. Now, this isn't to say there's a free lunch on offer here. Few, if any, trends last forever, and history suggests that if a nasty UK or global recession hits home, then the FTSE 250 could lag and do worse than the FTSE 100, so those premium historic returns can come with above average risk. So only you will therefore know whether the Vanguard 250 tracker will fit with your personal overall investment strategy, target returns, time horizon and appetite for risk, and that's something that you have to consider before you do put any capital at risk and you do your research. So thank you for watching, and I look forward to seeing you next time.